All right, so let's go ahead and get started. Welcome to Strategic Resource Management's Perspectives Live, where we discuss the intersection of traditional finance and emerging technologies. Today, I'm joined by some of my colleagues, many who are subject matter experts in the technologies that we will be discussing today. So I invite them to add commentary as we go through this presentation. Today, we're going to be talking about some technologies that traditional banking is having a hard time keeping up with and that fintechs are increasingly using to take market share. So I'm going to start with some surprising statistics. In 2024, digital banks and fintechs captured nearly half, or 44%, I'm rounding it up, but 44% of all new checking accounts that were opened in the US. So that's fintechs and digital banks opened 44% of all new checking accounts in the US last year, with companies like Chime and PayPal leading that account opening. Among millennials, the trust gap between fintechs and traditional banks has largely disappeared, and other cohorts is starting to show some weaknesses as well, showing that fintechs are now considered as trustworthy as banks, at least by younger demographics. That is something that has changed pretty considerably in the last few years, kind of post-COVID. Fintech companies like Chime saw a 53% user growth last year, pretty significant, reaching 22.3 million customers, demonstrating strong market potential and strong consumer interest. Fintechs currently account for about 5% of banking revenue in the US and 20% in payment-related fields. Projections suggest that by the end of this century, end of the decade, 2030, that fintechs and other non-bank competitors could capture as much as 25% of all banking revenues. So, these statistics, if you're a community bank or a credit union, could be a little concerning, and they certainly, to me, indicate a shift in market share. I believe this has a lot to do with the underlying platforms, so the core and other systems platforms that traditionally finance was built on, and traditional's finance challenge as it comes to embracing emerging technologies. And that's just kind of historic. With all that, let's discuss some of these technologies that are disrupting banking, and then we'll end with some recommendations in Q&A. And again, I do have the chat open. Feel free if anyone has any questions to just put something in the chat or raise your hands. So with that, let's talk about some of these technologies. It's worth reminding people that many large companies have disappeared because they have failed to recognize and adopt new technology / innovations. Blockbuster is certainly a great example of one of those. And why this might be, I mean, I always say traditional finance or TradFi tends to focus 80% of their efforts on protecting the past, kind of protecting their moat, right? And maybe 20% looking towards the future. We are conservative as a industry by nature. However, for fintechs, those numbers are reversed, right? They're focusing 80% on looking towards the future and 20% of focusing on their current business. As I alluded to earlier, banks and credit unions are having trouble keeping up with the pace of change. This includes not just understanding new technologies, but understanding risks, who are the likely winners and users, regulatory impacts, legislative updates, and challenges with integration efforts. The ability to stay relevant increasingly depends upon understanding emerging technology trends and making the right strategic investments in those technologies for the benefit of the consumer or member. Today, we're going to discuss in some detail technologies impacting traditional finance. In all fairness, each of these technologies are worth probably an entire discussion around, but given our time limitations, I'm going to just touch on a few of these. And if you bear with me a second, I'm going to launch a, see if I can find it here. I'd like to launch a poll. So let's see if this works out. All right, so we'd love for you all to just give us some feedback here. So the poll reads, which technology have you heard about the most in the financial services industry? So and kind of emerging technologies, AI, blockchain, open banking, real-time payments, or others, feel free to kind of throw it in the chat. So that's the first question. And the second question, we appreciate people answering. In your opinion, which of these technologies should we keep up with most in the fintech world? All right, we've got a fair amount of responses. Let me go ahead and end the poll, and then we'll share those results. So in terms of kind of what you've heard of, not surprisingly, AI and real-time payments kind of are up at the top of that list, probably followed by open banking. And then I didn't see anything in the chat, but in terms of opinion, which technologies should we keep up with the most in the financial world? I imagine those are probably all the ones on the slide, but I appreciate you answering that poll. So with that, let's jump into this here. So kind of per the polls results, and no surprise here, AI is likely one of the most disruptive technologies of the century and is starting to make inroads into banking, particularly through personalized financial services, fraud detection, risk management. For instance, AI-driven chatbots enhance customer service by providing instant support, personalized advice. On the back end, AI algorithms can analyze vast amounts of data, identify patterns, and predict potential risks, thereby improving decision making. Just to give you an idea how fast this space is moving, earlier this week, we received news that a Chinese hedge fund company introduced to the market an AI model called DeepSeek. This model is open source, significantly cheaper, more efficient, and can run on consumer grade GPUs. We also learned today that Alibaba's AI model called Quinn has claimed to beat both DeepSeek and OpenAI's ChatGPT. The way we look at it is this kind of this rapid improvement in performance and stiff competition. We had a conversation about this yesterday internally. We think it's likely going to result in cheaper, faster, and certainly more wide range adoption of AI throughout society and obviously in financial services. By 2030, it's estimated that AI will drive a collective $1 trillion in savings or a 22% reduction in operating costs for the financial services industry. So quite a bit of cost-cutting, expense savings as a result of AI. Now, quantum computing, while not getting as much attention in AI, holds the potential to revolutionize the cryptographic security and solve complex problems much faster than traditional computing. This could dramatically enhance data encryption and cybersecurity measures, making our financial transactions more secure. Advances in quantum computing, while not quite as fast as AI, is starting to pick up, could be a risk to the current cryptography that banks and credit unions use to secure their information. A scalable quantum computer would likely perform calculations exponentially faster than a modern classical computer. In fact, Google recently announced that their quantum Willow chip needs just 5 minutes to solve a problem that would take a conventional supercomputer around 10 septillion years. I don't know how long 10 septillion years is. I think it's longer than the universe has been around, but I think it speaks to the power of the supercomputer or these quantum computers in their ability to kind of break or solve problems that in the past have been unbreakable. It's still very much in its early stages, and it's going to require significant investment in research, particularly before it's kind of commercialized. However, the potential market impact is significant. It's estimated that by 2030, quantum computing could create 450 billion to 850 billion in annual value across various industries, with financial services being a key beneficiary due to quantum's capability to solve complex optimization problems. So that's That's AI and quantum computing. See a question there or comment. Connor mentioned there's also a Chinese research paper claiming that they got cheaper, smaller versions of Meta and Alibaba's AI models to self-replicate. That's interesting, which is an important safety benchmark. And thanks, Connor, for providing the link on that. That's fascinating, if not terrifying. So we've been getting a lot of questions, kind of moving on the next slide here around blockchain, digital ledger technologies, and tokenizations. I've been getting a lot of questions about the new administration's approach on blockchain, tokenization, cryptocurrencies, and what that means for the financial services world. We will provide a link to a recent article. I'm wondering if I threw that link in there yet. I didn't. That we posted addressing just that, and his title, Does a Crypto Administration Matter to Banks? So just bear with me a minute, and I'll pull that link up. Just share this with, share it in the chat. So there's the article if you're interested in reading it. Blockchain offers a decentralized and transparent way to record transactions, reducing fraud and errors. It's particularly valuable for cross-border payments, smart contracts, and supply chain finance. Banks can leverage blockchain for more secure and efficient operations. In fact, Elon Musk's Doge team is currently exploring using blockchain as a platform for its government expense reduction initiatives. The blockchain market is expected to grow to 67 billion by 2026, and blockchain is already enhancing transparency, security, and efficiency in financial transactions. Cryptography is fundamental to blockchain and other digital ledger technologies. The global cryptography market is expected to be worth about 8 billion today. Cryptography, it assures that security and integrity of data by encrypting transactions, making them tamper-proof. Public and private keys, which are essential components of cryptography, enable secure transactions and user authentication. Additionally, cryptographic hashing provides a way to verify data integrity, which is crucial for maintaining trust in decentralized systems. An example of cryptographic keys being utilized in finance is Apple's passkeys. So most of you are probably starting to get familiar with Apple's passkeys. It's a great way to hold your passwords. Basically, they utilize a private and public key cryptography where a unique pair of cryptographic keys is generated for each account, with a public key stored on the server and a private key kept on the user's device. Cryptographic keys are much more secure than the various two-factor authentication methods that most financial institutions are using. And then tokenization converts real-world assets into tokenized digital tokens. It enables fractional ownership and more accessible investment opportunities. Tokenization could increase liquidity and broaden the range of financial products on the market. The market for tokenization is currently about 225 billion and represents a very small amount of the total physical market that could be tokenized. According to a report by Boston Consulting Group, the tokenized asset market could reach a potential size of about 16 trillion by 2030. Digital ID systems create secure and verifiable identities, reducing fraud and streamlining know your customer processes. Digital IDs can speed and ease onboarding and lower fraud. This is especially important given the increase in AI-enabled fraud, such as deepfake videos and AI-generated images that are currently undetectable to humans. By 2025, it's predicted that 5 billion people will have access to digital ID solutions, enhancing security and efficiency in banking. Give you an idea, just kind of currently in the world today, India's got 1.3 billion people currently enrolled in their digital ID. China has about 1 billion. Brazil's got about 100 million users. So kind of combine these technologies on the slide, blockchain, cryptography, tokenization, digital IDs. In my mind, kind of, they're all part of the same digital ecosystem, but they offer the benefits of providing secure instant final settlement, 24/7, 365, in a more efficient and global process than do current real-time payment solutions like RTP or FedNow. So speaking of real-time settlement, consumers want instant payments for sure. Most notably, 61% of millennials. Also, 45% of businesses have responded that faster payments methods would lower their costs and make processes more efficient. According to a survey by the Federal Reserve, now this is back in 2022, but 28% of businesses highlighted slow payments as a major challenge. So you got 45% of businesses wanting faster payments to lower costs, 28% of businesses seeing slow payments as a major challenge. Access to low-cost, real-time instant payment systems would allow businesses to reduce working capital, reduce payment failures, and certainly speed up the business operating cycle. Despite real-time payments gaining adoption in recent years, the instant payments market still is largely untapped. In 2024, real-time payments accounted for only 1.5% of total payment volume in the US. However, real-time payments are expected to increase in popularity, with some predicting that they will account for about 4.8, call it 5% of total payments by 2028. I don't think this is unrealistic because current slower A to A or bank-to-bank payments, which are mostly done by ACH, already represent 5% of e-commerce transactions, and I expect A to A popularity as well as real-time alternatives to grow both online and ultimately in store, especially if we see some more partnerships like the recently announced Walmart-Fiserv partnership that reduces frictions for these types of transactions and expand their usage. In the US, the existing real-time payment networks include the clearinghouses RTP and the Fed, or the Federal Reserve's FedNow. There are some similarities. Transactions on both FedNow and RTP are real-time and are execute payments that are irrevocable, meaning non-reversible. However, the networks are not interoperable with one another, and it does create a challenge for financial institutions who want to offer their customers access to both networks. This year, we may see stable coins as well as tokenized deposits. Both of those could help bridge the gap between traditional banking and digital currencies. For those not familiar with stable coins, they tend to be a kind of a proxy for cash, tend to be backed one for one by assets like US Treasuries and cash. Tokenized deposits are a proxy for deposits, but on a fractional reserve basis. Stablecoins, tokenized deposits could offer an alternative to FedNow and RTP, certainly in some cases more flexible. Most large FIs are already trialing stable coins, trialing tokenized deposits, as well as other tokenized assets. Some good examples would be the Regulated Liability Network, or the RLN, or the Regulated Settlement Network, RSN. And then finally on this slide, central bank digital currencies, or CBDCs, could provide a government-backed digital currency, enhancing monetary policy implementation and financial inclusion, while potentially reducing costs and increasing payment system resilience. CBDCs are being explored by a number of central banks, with over 80% of central banks actively researching or developing central bank digital currencies. In the US, at least based on Trump's recent executive order, it does not appear that we will be getting a CBDC anytime soon. This would, in my opinion, likely pave the way for alternatives like stable coins and tokenized deposits. I see a question in the chat, Connor, to everyone. Do real-time solutions that other countries have running support refunds and chargebacks? It's a good question. Is there any data on how much more or less their payment rails cost versus current US options? So I can probably answer the latter on that. So like PIX and UPI, PIX is Brazil and UPI is India's real-time payment system, which were both supported by the government, are remarkably cheaper than kind of the current payment rails that we are used to. And in Brazil, at least, PIX has overtaken both MasterCard and Visa credit and debit card transactions. So it's being used predominantly there. I don't know that they support refunds or chargebacks or how that works, but maybe someone else can throw that in the chat if they know. Great comment. Okay, so open banking, I want to go ahead and see if we can come up with another poll. So just give me a second here. Okay, so this poll in regards to open banking, do you think that open banking will help level the playing field between large and small banks? This is like a head-to-head horse race here. And meanwhile, we're looking at that poll. Prakash, thanks for responding to Connor's question that disputes are taken directly taken by the merchant and not the bank. All right, a couple more seconds for the open banking question. Okay, let's go ahead and end that poll. So 58% of you responded yes, that do think that it will help level the playing field between large and small banks. 42% said no. Probably could have put another category, not sure. I think I would fall in that other category. So let's talk about open banking. It allows third-party providers to access bank data through APIs, which fosters innovation, competition, and in theory, customers would benefit from more personalized financial products and services. Last year in October, the Consumer Financial Protection Bureau, we all know them as CFPB, finalized a rulemaking on personalized or personal financial data rights. They called that the final rule, and that was intended to accelerate a shift towards open banking with the goals of reducing financial institution lock-in, improving consumers' access to financial services on competitive terms, and enabling new functionality through increased access to customers' personal financial data. I've heard it explained before as like when you were able to finally take your phone number and move it to a new phone when you change phone providers, and that drove a lot of competition, certainly a lot of benefits for the consumer. Open banking should allow financial institutions, credit card issuers, and other financial providers to securely share and exchange data through application programming interfaces. I mentioned that once before, APIs, enhancing transparency and giving customers greater control over their data, who they share it with, and for what purpose. While some larger providers are already utilize open banking APIs, most credit unions, regional community banks are still very much in the early stages and or are on the sidelines, as use cases have generally been pretty narrow in scope. Additionally, up until earlier this month, there were no real standards for setting open banking APIs. Like Europe did that and they had standards and governments got involved. Here in the US, we haven't seen any standards, again, up until 3 weeks ago. 3 weeks ago, we got news from the CFPB that I think they had selected the Financial Data Exchange, also known as FDX, not to be mistaken with FTX, the failed crypto company. So Financial Data Exchange, FDX, was officially recognized by the CFPB as the organization, or at least an organization, that will set standards for the open banking rules. So that helps quite a bit. I think, though, given the new Trump administration, time will tell to see if there's going to be any disruptions to or delays in the CFPB's required rollout of open banking. So I'll pause for a second, see if there are any questions or comments, if anyone wants to put anything in the web chat. All right. If not, moving along. So banking as a service and embedded finance. So banking as a service, some people call it BaaS or BaaS. I'll just go with BaaS, allows non-banks to offer banking services via APIs, enabling seamless integration of financial services into various platforms. BaaS arrangements enable fintechs to offer banking-like products such as checking accounts, debit cards, and loans without obtaining a bank license. So they're literally using the bank's license through that arrangement. The BaaS market is projected to reach about 12 billion by 2030, and embedded finance solutions which leverage BaaS are projected to generate 230 billion in revenue this year alone. Embedded finance leverages banking as a service as the underlying technology to seamlessly integrate financial services directly into non-financial platforms, essentially allowing non-bank businesses to offer banking features within their existing applications or websites. In simpler terms, BaaS acts as the engine that powers embedded finance by providing the necessary banking functionalities to embed within other platforms. For those of you that might be interested in a deeper dive, SRM recently released an in-depth study, Steve Wright's Perspectives Report, on the evolving banking as a service or BaaS ecosystem, highlighting both opportunities and risks. Some of the insights from that research piece included learning from recent failures like Synapse Financial Technologies, how to navigate regulatory challenges, actionable strategies to strengthen FinTech partnerships, enhance compliance, and to drive responsible innovation. Again, that research piece is part of a paid subscription service, so anyone interested in receiving a copy, please reach out to me directly. Okay, so payment ecosystem modernization and payment hubs. The modernizing the payments ecosystem involves creating more integrated and efficient systems, often through payment hubs that basically consolidate various payment channels like ACH, RTP, FedNow, RTGS, which is real-time gross settlement systems like Fedwire, and global messaging networks like SWIFT. The modernization of the payment system is crucial for handling increased volume of digital transactions. By 2026, it's estimated that digital payments will surpass 10 trillion in value. Modern payment hubs can streamline processes, reduce costs, and improve customer experiences by integrating various payment methods into a cohesive system. This is one of the things that, by the way, SRM advises on is these payment hubs, how to do it right. And Prakash on our call here is one of our experts in that space. Over 70% of banks are planning to implement a payment hub within the next 3 years. Payment hubs are also used by other industries, including retail, e-commerce, and B2B transactions. Some of the leading payment hub providers include ACI Worldwide, FIS, Finestra, Temenos, Oracle, Finzly, and Valente. I think I pronounced that last one correctly. Let me see. I do want to do a poll on this one, so just bear with me. Should I get the right one? All right. So here's a question. This is really a fill in the blank question, and I think you guys can just put this in the webinar chat. I'd be curious if, and Prakash probably would be the best one to answer this, but are there any other benefits to the payment hubs? I mentioned some here on this slide, but I'd be curious to see if anyone thought there were other benefits that we might not have touched on. Not getting any responses on that one, so I'm going to assume that we did a pretty good job answering that question. All right, so finally, we've got a few other edge case technologies that could be disruptive to traditional finance. I've really listed them here more for your reference. I'm not planning on discussing any of these in detail. If there's something on this slide or something we didn't cover that you were looking to do a deeper dive into, definitely let us know, and we can consider making it an upcoming discussion. So given all this technology change, how should a bank or credit union proceed? So we've got a few basic recommendations. First, we always like to say, especially in the AI space, doing nothing is not a strategy. We would encourage everyone to educate yourselves on these various technologies. One way to do that is identify passionate SMEs within your organization to help keep up with those technologies and identify use cases as well as risks. Second, go out and experiment with these technologies. Observe what your competitors are doing and how they're leveraging these advancements. Is that experience seamless? Is it enjoyable? Is it providing the expected results? Is it reducing barriers to entry? Those sorts of things. And then, find a trusted advisor like Strategic Resource Management to help you educate your team on these technologies, build a strategy around it, identify and vet potential partners, help with integration efforts. We now have an integration business. We didn't used to do that in the past. We now do deep integration for everything from core processors to digital platforms. And we also can help with developing go-to-market approaches. And then finally, measure. As you roll these things out, see how it's impacting you, hopefully in a positive way, but iterate, find better ways to use the technology and build upon that. So now I'll take any questions that you might have had or have. Feel free to put any questions in the chat or raise your hand. We can unmute you. I'm just going to pause my sharing the screen so I can see folks. If anyone's interested in adding some comments or questions about this, please throw something in the chat. Any of our SMEs want to add anything? Oh, we do have a question. Oh, can you put back up your contact slide? Absolutely. Coming up. Okay, so a couple different things here. You can go to, and I'll throw this in the chat. You can go to srmcorp.com. So srmcorp.com. That's our website. You can also reach out directly to me at lpruss, L-P-R-U-S-S, at srmcorp.com. I am also out on LinkedIn. I'm happy to put you in contact with any of the other SMEs that you might be interested in. Any other questions, thoughts? Okay, so we have a question from Connor. At what point do you think we might get blockchain widely used as payments infrastructure? And what are the main obstacles? Well, so the answer is it's already being used as payments infrastructure for stable coins, as well as cryptocurrency, but that's probably not so much around payments. Stable coins are being used pretty widely. In fact, there is from a pure dollar standpoint, more stable coin transactions processed last year than Visa. So, I mean, it was something like $11 trillion of stable coin volume that was processed over the blockchain. Where we see those go, it's hard to tell. We could see merchants start adopting stablecoins as a type of payment. There would have to be a discussion around why would anyone give up using their Visa or MasterCard for that. I could make an argument about merchants providing rewards around that because it's cheaper for them to process. But like one of the things big hurdle that we'd have to get past is getting some regulation around stable coins. So until we've got some very defined laws about 100% backing, redeemability, are these things bankruptcy remote, those sorts of things are going to provide some reluctance from merchants to accept stable coins. But once we get those, and I expect we will see that kind of legislation from Congress sometime this year, I would expect that just yet another payment rail of the many payment rails that are out there, U.S. consumers will have access to. Oh, Sorry, looks like someone had trouble with my QR code generator. Looks like I might need to update that. Yeah, just that was supposed to direct you to my LinkedIn. Again, you can just find me, Larry Pruss or Lawrence Pruss, Pruss on LinkedIn and reach out to me there. Any other questions from folks, audience? If not, I hope you enjoyed this. I want to thank you all for spending the time with us and hope to see you at our next Perspectives Live event. You can follow us on LinkedIn for updates. And with that, we'll go ahead and end the webinar. Again, thank you very much for everyone's participation.